So good evening once again everyone. So in this session our target is being structured now. Say our agenda for the day. So yesterday we have broadly looked into the cases of value of supply until the case of special valuation that we have under section 31, rule 31A onwards. We have not gone through that. Rest everything we have finished. Now today we will look at special valuation. Apart from that, we will look at the concept of pure agent, and look at circulars, few more to close that discussion. We will look at charge, RCM cases of goods, RCM cases of service, nine subsection 4. These two comes from 9 subsection 3. We'll also look at the connection between RCM and ITC. Then we'll look at what is the structure of RCM and registration. We need to also look at computation of net GST payable. This is going to be answering your compulsory question. This is the target that we are fixing for the day. Okay, so we'll go through all of this and then try to have some kind of an understanding of how to answer that compulsory question. That's a plan. Okay. Now let me take you through the first segment of discussion, which is special valuation and pure agent. I'll open up the discussion notes, then we can look at it from there. So we've looked at from rule 27 till rule 31 in that order and try to understand with certain examples, right? Now we will have to look at, there are some special valuation that is available from rule 31 onwards. I can show you the summary first and then come back to this and then discuss. Okay, so you can see here, if you are referring to the PDF books that you have got, some of you guys have got from TaxSchool, then you should look at page number 150. You would find those there. Rule 31A, which talks about how to compute value of supply in case of lottery, betting, gambling and horse racing. And there's a special valuation method that we have to apply for lotteries, betting, gambling and horse racing. If you remember, there are 6 activities in actionable claims which are defined as specified actionable claims under GST. Out of these 6 specified actionable claims, here you can see 4 of them are mentioned there. Lottery, betting, gambling, horse racing happen to be 4 of them. There are 2 more. Those are actually mentioned in 31B and 31C. So if you look at 31B talks about how do you determine the value when your supply happen to be online gaming, including online money gaming, primarily capturing online money gaming, but online gaming also falls into the structure. You know that from your 1st October 2025 onwards, there is a prohibition on online money gaming. Real money gaming, RMGs, are actually not allowed in India anymore. Now, though that particular provision has come, there is no corresponding amendment that is there in your GST provision to assess and then collect taxes from the earlier structure. They still make the same provision available there as well. 31C talks about how do you determine value of supply in case of casinos. Let's look at what is the valuation that we have. In case of lottery, earlier there used to be two separate rates that were available. Like when the lottery was state run lottery, which are authorized to be sold only within the state, which means it is not authorized to be sold outside the organizing state. Such kind of lotteries used to have a lower rate compared to the state authorized lotteries, which are authorized to be sold even outside the organizing state. Now, considering lottery to be a service, or lottery to be an actionable claim, and lottery to be taxed at a higher rate because it has this addictive in nature, so government has decided to come up with a common rate for both state run lottery and state authorized lottery. Additional point is that if you look at for May 2026 exam onwards, the tax rate of lotteries are increased to 40%, but for your January exam, it needs to be considered as 28% itself. Now, how do you determine the value? Now, for the lottery, when it is supplied by the state to the distributor, the value of supply would be determined as face value or the price notified to be assumed to be inclusive of GST, which means what? Value would be face value or the price notified by the government, whichever is higher, into 100 divided by 128. So what is that we will assume? Say there is 1 lakh lottery that is printed by Kerala state government. Each lottery is having 100 rupees as the face value, which means the entire lottery, 1 lakh lottery, 100 rupees makes it 1 crore. Now, this 1 crore would be treated as if it is inclusive of GST. To compute what is the value, the computation would be 1 crore into 100 divided by 128. Now, what you have to remember, if there is a price notified by the government, kind of e-lotteries and all that, you will have to take whichever is higher in that particular case. Also, it is the same rate that is applicable for all kind of lotteries, what you have to remember here. Now, lotteries are also being charged at reverse charge. It will be, technically this is paid by the distributor at their end directly to the government, but this is the rate that will be applicable. Going into the next understanding, value of betting, gambling or horse racing. Now, for betting, gambling, horse racing, I told you there are 6 actionable claims. Lottery is separately considered. Now, betting, gambling, horse racing has a common valuation. It's saying that the value would be 100% of the face value of the bet or the amount paid into the totalizer, which means that if I'm putting say I'm participating in a betting game, there's a horse racing, I'm buying tickets for 10,000 rupees. I'm just putting bet amount of 10,000 rupees into a horse. If my bet amount has to be 10,000 rupees, I will effectively will have to pay 10,000 plus 28% taxes, which is 12,800 needs to be paid to the organizer of the bet. Then only 10,000 will be considered to be the face value of the bet, because value for the purpose of GST is considered to be the face value of the bet itself. How much is the money that you're putting in? Why these words are important today is that in the earlier tax regime, the taxation for the lotteries used to be something different. For the purpose of lotteries, the taxation used to be for the purpose of betting, gambling, horse racing, the taxation used to be different. How that was different is, when somebody is organizing a bet or conducting a horse race, the taxability primarily came from commission that was collected by the organizer. Here, the change in understanding in GST is that the entire face value would be subject to GST, not the commission collected by the organizer. So even though the organizer will book the income only for the commission or the fee that they charge for organizing this bet, from each person maybe 10%, 20% will be taken as the fees. But GST is applicable on the 100% of the bet value, right? This is the understanding. Now you look at online money gaming. It's a very strange provision that we have here. We will try to understand that first. Okay. Let me show you some notes to get your understanding correct here. So these two 31B and 31C, these two were introduced by 1st October 2023, and the provisions were slightly tricky here. Let's try to understand the provisions. So it says like this: there's a new valuation rule inserted, 31B and 31C, and 31B talks about value of supply for online games including money games, and 31C talks about value of supply for actionable claims in case of casinos. What is value here? They are saying that the amount deposited, the word that they have used is amount deposited, will be considered to be the value here. Now what is the meaning of amount deposited as such? They are saying amount deposited including virtual digital asset by or on behalf of the player. Let's take an example of an online money gaming platform. Typical example would be Dream 11, because it was one of the biggest platform that we had for online money gaming. So you participate in a game. So if, say for example, there is a match that is happening today between India and South Africa. Now if there is an India South Africa match that is happening, you could go into Dream 11 platform, create a fantasy team. You first add the money into the wallet of Dream 11, and then you utilize money from the wallet for each of the game that you are participating in. Now the GST provision has created taxability to the extent of money deposited, which means it doesn't matter whether you participate in a game ultimately or not. The moment the amount is deposited into the wallet of Dream 11, it would be treated as the value. Now the strange part of this provision is that they have created this provision for valuation not just for online money games. They're saying that even for online games, this would be the method in which they will create a valuation. Now what's the difference between online games and online money games is that for online money games, wherein you put money with an intention to win more money, online money games, the tax rate happen to be 28%, wherein online games are treated as supply of services and will be taxed only at 18%. Now what about the money that is refunded back? Say I put 500 rupees into the Dream 11 wallet and I utilize only 300 rupees out of it. Now this 300 rupees will be considered to be the amount that I am participating in the game. But the moment you deposit 500 rupees, we will consider this 500 rupees is inclusive of 28% GST. So what happens? The moment 500 rupees comes into the wallet of or the bank account of Dream 11, and then they are going to give you not the entire 500 rupees as the value there. They will treat that on this 500 rupees they are supposed to pay GST. This 500 would be considered to be inclusive of GST. Right? Sometimes in the examination question, what they will give you is that they'll say that Mr. X has deposited 500 rupees into Dream 11 or some other platform name they will give you. Sometimes in the question they will mention that the amount deposited is excluding taxes, which means that they're not just depositing 500, they're depositing 500 plus taxes, right? If nothing mentioned, we can also assume it like that. Otherwise, most of the cases what happens, if I'm depositing 500 rupees, this 500 would be considered to be inclusive of 28 GST and they'll have to first pay the GST, right? Now what happens? Out of the balance left in my game account, I will start utilizing this for participating in games. Now some games I will win, some games I would lose. So in case I am winning, I will again get some amount credited back to my wallet. I might reuse this amount again to participate in further games. The government says that that will not be again taxed, because everybody who's contributing money, the moment it was deposited in the wallet itself, it was already subject to GST. So Again, somebody is winning some amount is just basically within that particular platform, somebody is losing, somebody is winning. So government has already collected taxes on the amount deposited. So reusing of the winning amount will not be again taxed. However, the same way we will have to analyze another case. Say I deposited 500, I have only utilized 300, 200 I decided to withdraw. Can you reduce this 200 from the value? No, because amount deposited is considered to be the value. Look at the provisions that we have extra there. In both cases, amount refunded, that is unutilized or otherwise, shall not be deductible from the value. Amount received by player by winning an event or competition utilized for participating in further event without withdrawing will not be treated as an amount deposited and will not be taxable. The rate of online games are increased to 28% even for game of skills. So online money gaming, now the tax rate is increased to 28%. Okay, so that's the primary understanding. Now the same thought process is given for 31C as well. 31C talks about casinos. If you walk into a casino, you will first buy something called as a token, coin, chips to participate in the game. Now you don't buy as and when you're participating in a game, you will get enough tokens first and then you go around in the casinos and start participating in multiple games. The provision says that the moment you're getting the chips or tokens and you're paying certain amount, at that moment it will be subject to GST. That's the moment wherein you will end up paying the GST. So value would be the amount deposited for purchase of tokens, coins, chips for participation in event in casinos. That's the understanding that you need to have. You guys with me on this? The understanding that we had for online money gaming, like the fact that if at all say you went to Goa and then decided to go to a casino and you got some tokens first, you spent 10,000 rupees, you would have paid 28% GST already. Now you didn't participate in enough games, so you got some 2,000 rupees worth of token balance with you. You give this token back, you're not going to get the GST amount back, that's gone. However, you won extra 10,000 and again utilize for participating. Will that be again subject to GST? No. So when you win and again utilize, no. The initial deposit only will be subject to GST. If you look at, there is an RTP question that they have drafted. Then there is an examination question right in 2024 that they have asked on this particular area. So I'm not expecting that they will draft another question, but in an MCQ or any otherwise they can test this up. Going back to our next discussion. Look at rule 32 here, and rule 32 says what? Rule 32 talks about special valuation. Why there is this concept of special valuation? It's primarily because there are certain industry deriving value will be little difficult because value could sometime be a percentage of some other gross amount. To give a classic example would be money exchange business. Now as a money exchange dealer, what is my income basically? Say I'm buying dollars and I'm selling dollars. In both of them, I'll create a commission called a spread. I will charge some extra amount and then I will sell dollars or buy dollars from customers, right? That's what primarily I will do. So the question that we have here is that will this particular commissions be subject to GST? Say somebody walks into my shop, I'm a money exchange dealer. They wanted $1,000. I gave them $1,000 and I got like 85,000 rupees. The entire gross amount of 85,000 rupees will not be subject to GST because this is considered to be exchange of money. Now, exchange of money will be treated as a supply of service when there is a separate consideration charged. What is a separate consideration that I have for money exchange business? It's primarily the commission that we are charging would be considered to be a consideration for supply of money exchange service. How do I compute the value? One method is that each time when I'm exchanging the currency, I have to look at what is the price at which I bought this currency primarily, right? Then I would collect a GST on top of it. The problem that we have in terms of this method of valuation that I've just suggested, sometimes I don't know what was the exact amount of purchase price that I had, because I would generally know what is the average price at which I would have purchased dollars, because one-on-one connection between the dollar I sell, dollar I purchase might not be very easily possible. So there Government said that you can either go for a special valuation. What is a special valuation? Rule 32 sub rule 2 says that if you are a supplier in money exchange services, you have an option to go for a special value for a particular financial year. Even in 32 sub rule 2, you have been given two options to go for. Out of these two options, you can choose between options in a financial year. You can swap between the options as well. Now let's look at what is the option that is available. Now apart from this money exchange businesses, there are multiple other businesses also who will be eligible to go for this kind of a method of valuation. I'll show you the summary as well. You can see the summary table that I have kept here. Rule 32 sub rule 2 is talking about money exchange business. Sub rule 3 talks about air travel agent. Sub rule 4 talks about life insurance risk plus saving schemes. 32.5 talks about second hand dealers, wherein they're talking about something called as a margin method. Then 32 sub rule 6 talks about vouchers when it is redeemed, which is again not going to be relevant because there is an amendment on vouchers. 32.7 talks about power for the government to notify nil for certain related persons and distinct person transaction. Now, primarily what you have to know is that this one area is very easy to score. How? Most of the questions, if you go back and then analyze the question that so far tested. So I'm showing you the summary here that you can keep. The same summary is being uploaded on the TaxSchool free resource as well. I can share it on the Telegram group if you guys want. Now, if you look at this particular area, when you analyze it for the examination, was being tested as a direct application question. They'll give you a scenario, they'll ask you to compute what will be the value for this particular case. It's a very simple case that we have. Now let me go through the cases so I can explain this further to you guys. Say let's primarily look at the money exchange business. I have two options available. First option is that they're asking if the money exchange that you do has RBI rate based valuation possible, then you can opt for that. What is this option A? If you have gone for, you'll have to do for every transaction when you're exchanging a foreign currency, you will have to first look at is there RBI comparable rate available. Then say for example, you sold the dollars to the customer for 86 rupees per dollar. RBI rate available was basically 85 rupees. Now the difference between the RBI rate and your selling rate would be considered to be the commission for you or the value of supply of services for you. So that's the first method. Buying selling rate minus RBI rates. Basically selling rate minus RBI rate and RBI rate minus buying rate. So that's the thought process. But you know that the difference you need to take from RBI rate is the understanding. Then not every currency has a corresponding RBI rate available on a daily basis. Suppose you are transacting with another currency like a lira, which does not have an RBI rate available. Then what do you do? We'll assume 1% of your gross currency exchanged in INR will be considered to be the commission that you would have received. We will make an assumption like that. The third one, you're converting one foreign currency to another foreign currency in India. So you're converting dollars into euros in India, and I will have to take 1%. If even for me to take 1%, I should have an INR value to take 1%, right? Now this both of them are foreign currency. So how do I compute what is the commission that I have made? Say somebody from US came here, I converted and they gave me dollars and I converted them into euro because they wanted to go to Europe after that. So what should I do? I should convert dollars into INR first and euros into INR first. After doing this, I will take the lower gross amount and then apply 1% of that as my commission. That's the first method you have. Now the second method is fixed rate method. What is the meaning of fixed rate method? You will have to treat it as if it is like a slab rate. Like we have it in income tax that we do something called as a slab rate, right? We will have to treat it as if it's like a slab rate. What is the structure that we have for slab rate? They said, look at how much each transaction, again both of them you are doing this for each transaction. Look at how much the currency has been exchanged. If your gross currency exchange, say somebody exchanged $1,000, then $1,000 into 86 rupees is what I've collected. 86,000 comes into the first slab because the exchange is up to 1 lakh. 1% of gross currency will be treated as the commission. Minimum 250 will be treated as the value. Your exchange is 1 lakh to 10 lakh. For the first 1 lakh, you take 1%, which is 1000 rupees is the value. plus for the difference you take it as 0.5%, because the more currency you exchange, the spread comes down. Then if the amount is more than 10 lakhs, for the first 1 lakh it was 1%, 1000. For the next 9 lakh it is 0.5%, which is 4500. So above 10 lakhs you will treat it as 5500, plus for any difference above 10 lakhs will be 0.1%. Then the maximum value per transaction I would take would be 60,000 rupees. This is the second method. Now how the question, and you can swap between these methods only after a financial year. Now, do you get questions on this? Yes. What kind of questions you can have? I'll show you one question, so I'll tell you how easy this can be answered. Look at question number 17 that I have put it on the screen. Prada Forex Private Limited, registered in Delhi, is a money changer. It has undertaken the following purchase and sale of foreign currency. Number one, 1000 US dollar are purchased from Nandi Enterprises at the rate of 74 per US dollar. RBI reference rate for US dollar on that day is 74.6. Right? So, second case, 2000 US dollars are sold to Menavati at the rate of 74.5 per US dollar. RBI reference rate for US dollar of for that day is not available. Determine the value of supply in each of the above cases in terms of rule 32 sub rule 2 clause A and 32 2 B. So this, they're giving you both of the transaction, asking you to compute what will be the value in both clause A and clause B in this particular scenario. How do you do that? So let's look at the first case. $1000 are purchased from Nandi Enterprises, 74. RBI reference rate is 74.6. So 0.6 into 1000, that is 600, would be the first method of valuation, that is clause A. Second method is that you have to convert 1000 into 74. This is 74,000, which is less than 1 lakh. So 1% of that, which is 740, would be considered to be the value. Second case, $2000 is sold to Menavati at the rate of 74.5 and RBI reference rate is not available. So 74.5 into 2000 into 1%, 1490 would be considered to be the value. Now you will have to look at 2000 into 74.5 will be coming under which slab? You find that it is coming under the second slab. So it is between 1 to 10 lakh. So what you will do? You will do 1000 plus for the difference 0.5%, which gives you 1000 plus 245, 1245. This is a very straightforward application question, no complication. You can get 3 to 4 marks out of this. So this can be tested as the sub question in question 2 or 3 or 4. On those questions, they can still ask you one of these as a question. If you're getting one of these segment, it is considered to be that you're writing one of the easiest examination. Next one, air travel agent. Air travel agent also has very complicated commission structure. There is front end commission, back end commission. So very difficult to find out how much needs to be considered to be the value of their supply. Because whenever we are paying, I'm not talking about convenience fee, I'm talking about the value of supply for air travel agent from when they provide services to airlines. Say if you book, okay, I'm trying to give you differentiation here. If you're trying to book a flight ticket in Make My Trip, for example, at the end of the Make My Trip booking, there is something called as convenience fee that is separate, that will be anyway subject to GST on the convenience fee charged. However, the 10,000 rupees that you would have paid for booking the flight ticket value, that also includes a commission which is paid typically by the airline to the air travel agent. Now this commission is very difficult to derive because overall settlement will be net of this. To derive the value, they say that you can go for 32 sub rule 3 valuation method, wherein if it is domestic booking, you treat value to be 5% of the basic fare. And if it is international booking, you treat 10% of the basic fare as the value. This is the structure that you have. Okay, so look at the 32 sub rule 4 computation. 32 sub rule 4 talks about special valuation for life insurance business which covers risk plus savings. Now, life insurance is a strange industry that we have in India. We penetrated to have life insurance called as savings insurance. Now, savings insurance is a combination of investment and coverage of risk of life. Now, insurance is subject to GST. I'm saying uh, not for May examination. May examination, life and health insurance would be now exempted, considering that there is GST 2.0 amendments that has come. Let's just assume that I'm talking about Jan examination only. So this would actually go for a change. Now, amount allocated towards, say for example, there are two type of insurance: term insurance or insurance which covers only risk of life, wherein you pay a very small premium. You don't get this. Now today, if you go buy a life insurance, you pay the life insurance premium for a very large period of time. At the end of certain terms of insurance, you will get the money back. If you're getting the money back, it is called as savings insurance, because the insurance company is not just allocating your amount towards risk, it is allocating your amounts towards investment, and they are giving you back the money at the end of your tenure period, right? Now, considering this, if you are having something called as a savings insurance, the insurance premium that you pay has a component of investment which should not be taxable. It has a component of insurance which should be taxable. To derive the value in such kind of an insurance, they have given you a method. Now look at, if the insurance is a term insurance that I have written as a note here, the entire premium is allocated towards risk. Term insurance, that full premium will be subject to GST. However, if it is a savings insurance, it has a component of risk plus savings. We have to first identify what is the amount allocated towards savings. Is it separately available and intimated to the policyholder at the time of insurance service? A lot of insurance, if you look at, they will give you in the policy document itself that this much of amount will be allocated for savings, this much of amount will be allocated for insurance or risk. In that case, it is very easy for you to compute the value. Value would be what? Gross premium charged, which is the total premium minus the amount towards investment, which will give you what is the exact value for your insurance business. What if I am not communicating this separately to the insured at the time of selling the insurance? Then how will I determine the value in that cases? When we have to ask the question, is it a single premium annuity policy or other cases? If it's a single premium annuity policy, then 10% of this gross premium will be treated as the value of the insurance. And if it is other single premium, means one premium only you will pay for, say 20 years of coverage. 10% will be treated as the value. If it is not single premium policy, first year 25% of the gross premium will be treated as the amount allocated towards insurance, and subsequent years half of it, which is 12.5%, will be treated. 32 subsection 5 subrule 5 talks about margin method. Why margin method is applicable? This is to avoid double taxation in a lot of cases. When a person is dealing in buying and selling of second hand goods, what happens? I purchase certain goods and I did not take any input tax credit, and I'm further selling this particular goods. Then what happens? I would have already paid GST at the time of purchase of this particular product. If I'm asking this particular fellow to pay the GST again while they're selling on the entire value, it means that it is double taxation. To avoid this, they have come up with a method called as margin method. Let's just look at the provision first, and then I'll show you through an example. Value in margin method would be selling price minus the purchase price. If this is negative, there is no tax payable. Now, second-hand goods here means used goods as such or after minor processing, which doesn't change the nature of the goods. The condition that we have is no ITC has been availed on the purchase of the same. Then there's a special provision that we have. They're talking about cases where if the goods are repossessed from a defaulting borrower who is not registered for recovery of the loan, I might not have a purchase price because I'm not purchasing it, I'm just recovering it from somebody who is not repaying my loan. Then the purchase price would be treated as actual purchase price of the borrower minus 5% for every quarter or part from the date of purchase and the date of disposal after repossession. Let me show you an example to understand this better. Mr. Raju purchased an iPhone 13 Pro from Imagine Apple dealer, paid 1 lakh plus 18,000 GST. He basically sold this particular iPhone after using it for 2 years to a second-hand dealer called as Cashify. Cashify bought this for 50,000, didn't pay any GST because Raju is unregistered. So there was no ITC as well. Now Cashify refurbished this particular iPhone and they are planning to sell this to another customer called Mr. Gopal. Now already this product was fully tax paid because at the time when Raju purchased, Raju has already paid tax on the entire 1 lakh. If I ask Cashify to pay GST on 60,000 again, this would amount to double taxation. To avoid this kind of a scenario, what they have suggested is that they said the tax is payable only if there is a margin or value addition that is made by the second-hand dealer, which means in this particular case, the second-hand dealer sold it for 60,000, purchased it for 50,000. The margin here is only 10,000. Only 10,000 would be subject to GST. What if the product was sold for 40,000? Which means they bought it for 50,000, they sold it for 40,000, there's a negative margin that they have, GST is not payable. What if GST is paid on the purchase and ITC is availed? Suppose Raju was also registered. So when he sold this second-hand product to Mr. Like Cashify, he basically charged GST from Cashify and Cashify has taken full input tax credit. In such cases, again the value would become 60,000 itself. Second case that we have is, what if it is not purchased? What if the second-hand dealer repossessed this particular machine? Mr. Raju, an unregistered individual, wanted to purchase a Maruti car, has taken loan from Shriram Finance, bought the Maruti car with an on-road price of 6 lakh on 1st January 2022. The same full 6 lakh was taken as a loan from Shriram Finance. Mr. Raju defaulted in paying EMI for 2 years and Shriram Finance decided to repossess the car. So they went to Raju, met him, took the car key and then drove the car to Shriram Finance location, saying that we're going to seize this particular car because you're not paying for the loan that you've taken on the purchase of this car. Okay, so they seized the car. After taking the car in custody, they decided to confiscate the car and then sell it to somebody else. So by 10th of January 2024, it was sold to Mr. Gopal for 4 lakh rupees. Now, Shriram Finance is in confusion. How much should be the value for the purpose of paying GST here, because Shriram Finance is now getting 4 lakh. They said this is a second-hand product where tax is already paid and it is repossessed. In such cases, to compute the purchase value, what is the method that we have to use? We have to look at what was the purchase price of the original, original person who has purchased the product. Who purchased the product originally? It was purchased by Mr. Raju. 6 lakh was the price. Then for every quarter that has been in use, I'll have to reduce 5%. How many quarters has been in use? They purchased in 2022 Jan 1. So entire 2022, 4 quarters. 2023, 4 quarters. 2024, part of a quarter also, 1 quarter, 1 quarter. So totally 9 quarters has been used. So 9 quarters of 5% means it has to be considered to be 45% depreciated. So 6 lakh minus 45% is 2,70,000, which gives you 3,30,000. 4 lakh minus 3,30,000 is the purchase price. Purchase price is 3,30,000, sale price is 4 lakh. So 70,000 would be considered to be the margin that will be subject to GST. Now let's move to rule 33. So the special valuation from 2 to 5 is something that is tested in the exam, so you have to be careful. Let's quickly move to rule 33 and then try to understand this. What does rule 33 talks about? Talks about the difference between reimbursement and pure agent payment. They're saying that if I collect some money from the customer and I pay this money to a third party on behalf of my customer, I would be acting as an agent for the customer. It is not part of my supply. I could exclude this from the value of supply and do not pay any GST on the same. We'll try to understand this thought process. They're saying that there are certain expenditure and cost incurred by the supplier as a pure agent can be excluded from the value of supply. Classic example would be, say, a chartered accountancy firm, like the CA firm where you did your articleship. would be paying a lot of income tax on behalf of the income tax assessees, right? All the tax audit assessees, you only might be paying the income taxes there. The question that we have there is that when there is an income tax amount that is being paid by the CA firm, it is charged in the bill that is given to it is charged in the bill that is given to the income tax or tax audit assessee. Should this income tax also be subject to GST from the CA firm's end? The answer is no. So CA firm is giving a bill, tax audit fee 1 lakh rupees, income tax paid is 5 lakh, 6 lakh in the bill was there. But this 5 lakh that is an income tax paid is a pure agent payment. It will be excluded from the values what is given here. So they're saying that pure agent payment will be excluded provided 3 conditions are satisfied. Number 1, pure agent supplier makes payment to the third party on behalf of recipient upon authorization. So client has told you to make the payment. Number 2, it is separately indicated in the invoice issued by pure agent. Number 3, third party payment is in addition to the service on his own account. The service on his own account was audit. Paying this tax was in addition to that, right? Then, who's a pure agent? Pure agent is somebody who has agreement with the recipient to act as an agent and incur cost of expenditure. Neither intends to hold or holds any title to goods or service procured. Does not use such goods or services for their own interest. Receives only actual amount incurred for such payment to third party. Then, look at the clarification that we have here. Question is that electricity included in renting and maintenance contract. Question is this. Sometimes what happens is that electricity is included in the maintenance contract. You know that there are so many apartments wherein welfare association, the residential association itself is billing the electricity charges to the members or the flat owners. Question is that will that be included in the invoice and subject to GST or not? So we have to ask the question, is the real estate owner or the residential welfare association acting as a pure agent, which means whatever may be the electricity bill that is paid to the electricity board is only charged from the customer, then they are a pure agent, which means that that amount will be excluded from the value of supply of renting or maintenance contract. If your monthly maintenance is say 10,000 rupees and electricity bill is 5,000, if 15,000 is billed and then the bill separately 5,000 are shown as electricity bill, that 5,000 will be reduced from the value. However, it is not included in the bill. The maintenance contract is to include for electricity also. Then bundle, it will be considered as it is bundled in the supply even if it's billed separately in the invoice. It's a composite supply, it will be taxed at the rate of principal supply, that is the renting or maintenance contract. Sometimes what happens, they will charge, see there could be an internally generated generator set and then there will be some margin charged by the association to the flat owners, commercial owners and all that is there. So if you have an office space also, sometimes electricity will also be included in the rent, like co-working spaces, etc., right? So they might mention EB separately in the bill, but they have added a margin onto it, so they're not acting as a pure agent, then it will be subject to GST. But electricity is anyway exempted, so what rate will be applicable? Rate applicable would be the rate of your maintenance or rent rate, that is 18%. That is the understanding they are giving by this circular. Okay, so now let's quickly look at the last area of discussion in our valuation chapter, which would be on corporate guarantee. Now let's try to have some kind of a clarity in what is corporate guarantee is all about, right? There is multiple wordings that I've given as such here. Will be little, they've asked so many questions so many times on top of this. So let's try to have that understanding on these circulars. First, what is a corporate guarantee? So when sometimes an company needs to take a loan, what happens is that there will be the holding company that might actually offer guarantee to the banker. So the loan is given to a subsidiary company, the holding company or some other company which are related to this company gives a guarantee. What happens when two companies are giving guarantee to another's loan? Primarily what happens is that the loan is given to company A, guarantee is given by company B, right? Question is this: will there be considered to be a supply between company A and company B in this case? Yes. Company B is getting loan from a bank because company A is giving guarantee. Sometimes what happens, there is consideration paid for it, right? Company B will pay certain amount to company A as a consideration. Sometimes what happens, there is no consideration at all. Now they're saying that if there is corporate guarantee, government wants to fix a consideration by default. For that, what they have done, they've inserted an additional sub rule under Rule 28 just to cater into corporate guarantee. So if you go back to page 149, you would find this. Notwithstanding anything contained in sub rule 1, value of supply of service by a supplier to the recipient who is a related person located in India. That's an amendment that they have added. By way of providing corporate guarantee to any banking company or financial institution on behalf of the said recipient shall be deemed to be 1% of the amount of such guarantee offered per annum or actual consideration, whichever is higher. They are saying that what is the total amount on which guarantee is given, you apply 1% per annum of that as the value, provided the guarantee is given by a related person. So when it is related person or distinct person, the valuation should be as per Rule 28. No? Now Rule 28 has sub rule 1, now they have inserted sub rule 2. So they said when a supplier is giving to recipient who is a related person in India, so the receiving company has to be the one who has taken the loan, no, that company has to be in India. That company, if they're receiving a corporate guarantee, the value for the supplier would be 1% of the actual consideration, whichever is higher. There's a clarificatory circular on it which we can quickly go through. Question number 1. Is GST applicable for corporate guarantees issued prior to 26th of October 2023? That is before this 26th October 2023 is what had this 28.2 as introduced. What if the guarantee was given before that? What is the provision for valuation of corporate guarantee issued before 26th of October and renewed even after that date? They said corporate guarantee between related person are a supply by para 2 schedule 1, which means distinct person related person concept. No, that related person supply is a supply even without consideration. So corporate guarantee even before this Rule 28.2 has come is treated as a supply. Rule 28.2 is only clarifying valuation. So before the introduction of Rule 28.2, valuation would have been based on Rule 28. Now this is Rule 28 sub Rule 1, but the older Rule 28 which says what? You have to take the open market value. If not available, like, kind and quality. If not available, Rule 30-31. That method would have been applied. For any renew, for those, look at the second part I have written. For those renewed on or after 26th of October 2023, now we will do the new valuation, that is 1% or actual, whichever is higher. Look at question number 2. What is the amount of corporate guarantee taxable if actual loan is not disbursed or partially disbursed? Can recipient of guarantee be eligible for input tax credit? First question, I have given a corporate guarantee, but the full amount is not yet released as loan. Doesn't matter. Corporate guarantee is to sanction the loan, right? Corporate guarantee is a supply of providing guarantee for the risk of default. It is not interlinked with the supply of loan service. It is taxable when guarantee is provided, not based on the disbursement. Second, when somebody is providing guarantee and then there is a valuation of 1%, can the receiving party take the input tax credit? Yes, recipient can take the input tax credit, no doubt, as long as they satisfy the condition. Question number 3. Is the takeover of loan by financial institution bank corporate guarantee already issued for the old loan be taxed again? No. If there is no fresh guarantee that is given, say there was a loan with ICICI bank. Now this loan is taken over by HDFC bank. If HDFC bank is asking for a new guarantee, then again there is a service provided, otherwise there is no fresh guarantee given. These are computational problems that we will have to analyze. Look at it. Corporate guarantee given by more than one related entities or co-guarantors. More than one related entities is giving guarantee. Right? What happens? I will have to look at the loan amount. Compute 1%. Right? If all the actual consideration that is paid by this each guarantor is more than 1%, then each guarantor will have to pay GST on the actual consideration. No doubt on that. Say loan is for 1 crore. So 1% of 1 crore would have been 1 lakh. But each of the person for guarantee has collected put together more than that, right? Some 1,50,000. So actual amount that you add up, that will be the consideration. Now, actual consideration is less than 1% for each of the co-guarantor. Then what I have to do? Take 1% and I will divide them in the ratio, right? Ratio of guarantee given. So to in the banking contract they would have given out of the loan 50% is guaranteed by me. Then take that ratio. That ratio is not available, give it to all the co-guarantors equally. Say the same example I'll repeat. 1 crore was the loan amount, 1% is 1 lakh. Nothing mentioned about who's giving. So it's a joint guarantee that is given by two companies. Divide them equally, 50,000, 50,000. Are you guys understanding this? So each of the company who has given the guarantee will have to pay GST on 50,000, 50,000. Even though there is no consideration collected, it will still be considered to be a supply. Now let's look at the who has to pay the taxes kind of a question that we will try to answer. Now the one who is guaranteeing the loan is in India, recipient is also in India. Now the one who is giving the guarantee will have to pay tax under FCA. The guarantor is in India, recipient is outside India. What is that they have said? Rule 28.2 will not be applicable in such cases. Why? Rule 28.2 now amended and said the Rule 28.2 1% computation will be applicable only if the recipient of corporate guarantee is in India. But if it is a case of the recipient is outside India, the company who's getting the loan is outside India, and then Indian company gave the guarantee. If there is an actual consideration, it will be treated as an export of service. There is no consideration, there is no taxes payable. Opposite, the one who's giving guarantees outside India, the company who's getting the loan or using the guarantees in India, then what will be applicable? RCM will be applicable. Supplier is outside India, recipient is in India. It will be taxable under reverse charge. Question number 6. How do you compute this 1% in Rule 28.2? 1% is computed per annum, right? Suppose the guarantee is given for more than 1 year. Like say in the agreement itself says that this guarantee is for 5 years. There is no renewal of this particular loan or further guarantee, even this guarantee is given for 5 years. Then how do I compute actual consideration of 1% into 5? Right? So actual consideration that is charged, or 1% of the the loan that you have taken, the amount on which guarantee is given into 5 years, and you compare these two and take whichever is higher, that would be considered to be the value. Say there is a 1 crore loan, 5 years guarantee, Actual consideration is 2 lakh. Then I have to take 1 crore into 1%, which is 1 lakh, right? Into 5 years, 5 lakh or 2 lakh, which is higher, 5 lakh would be treated as the value, right? When should it be payable? It is payable at the time of issuance of guarantee. However, if it is renewed annually, then 1% per annum is computed on an annual basis and higher of actual consideration is taken as the value and the GST is payable at renewals. If it is for 5 years and there is no renewal, the full GST is to be paid at the time of giving guarantee. If it is needs to be renewed, every year you can take that, right? What if the loan is taken for 3 months? Then I have to take it in proportionately for that order. I have to take actual consideration or 1% per annum into number of months divided by 1 year, or like number of days divided by 1 year, and you take whichever is higher, again payable at the time of issuance of guarantee. Question 7 is very important question. Now there is a clarification which says that if the recipient receiving corporate guarantee from related person is eligible for full ITC, what provision can be applied? I can apply the provision of value declared in the invoice as the deemed value in this particular case. So I don't have to bother about the higher valuation here, right? If the recipient receiving corporate guarantee is from related person is eligible for full ITC, value declared in the invoice will be deemed to be the value of supply. So there I don't have to bother about this. This much of point is there available in that circular. Is this clear, all of you? So very long circular. They can ask questions on all of this. Okay. So now the circular for us to discuss, it is on discount that is given after the supply. If you remember, in 15.3b, I told you that if the discount is given after the supply, it can be reduced from value if 3 conditions are satisfied, right? Number 1, it should be existed at the time of supply as per the agreement. Number 2, it should be linked to the relevant invoice. Number 3 is proportionate reversal of ITC by recipient. Now, how will the government take a understanding that they have actually reversed the ITC or not? For that particular sake, they have added an additional clarification and said, if the discount that is given for a financial year put together is more than 5 lakhs, what kind of discount? After the supply, then there should be a certification that is obtained from a CA that this particular amount is actually reversed in your DRC forms to reverse and then paid back. That kind of certificate needs to be obtained from a CMA, practicing CA. In that, they have to include the details of credit note, corresponding invoice, details of DRC3 or return in which you have reversed. Up to 5 lakh, if it's the total discount that you're basically reducing from the value, then you can make a self declaration and then do it. It's already tested. Let's look at this circular also. Clarification on warranty and extended warranty. We know that incidental expenses are to be included in value, which includes warranty and extended warranty as well. Let me give you the understanding of it. What is basically warranty? Warranty is like an insurance, right? Say there are two products. Sometimes they will call it as free warranty, but it's not really free. There are two products. One is giving you zero warranty. Another product is giving you 1 year warranty. Which product will be costing higher? 1 year warranty product will be costing higher. Why? Because warranty is like an insurance, right? So if there is sometimes what happens during the warranty period, any repair needs to be done. So if I'm Philips, which is a company which is selling you trimmers, and it is giving you 1 year warranty on the trimmers. What Philips would have done, created a large pool of service centers wherein if some repair needs to be done, they can be done. Now, how Philips would revise the pricing based on warranty? Say, Philips analytics team says that out of 10 trimmers sold, one trimmer would come back for warranty. So, 1000 rupees is the price of the trimmer. So, every time 10 trimmers are sold, I will have to replace one. So, 10 divided by, 1000 divided by 10, 100 rupees if I add it to the cost for each of the trimmer. Then by the time 10 trimmers are sold, I am getting extra 1000 rupees to replace one trimmer. So what they basically doing, they're just paying 100 rupees to a third party who will do the replacement. So warranty charges, if it is extra charged in the bill, that will be included in the value as an incidental expense. So look at it, warranty charges are generally included in the value of supply as an incidental expense under 15(2)(c). Then there is something called as extended warranty, which is an optional warranty that you can get. Now, optional, this extended warranties are either given by the original supplier or sometimes will be given by a third party. Today, if you go to Flipkart and Amazon and then purchase a product, they would ask you, do you want an extended warranty on this product for 2 years? Most of them are being given by insurance companies and others. So the question is, what should these extended warranties be added to the value of supply? Now, the question that we should ask, is it provided at the time of original supply? Say when you are buying a car, at that time itself they are giving you an extended warranty and it is provided by original supplier. Say you're buying a Benz car and the Benz itself is giving you 2 years extended warranty and you're getting it at the time of original supply. They said it will be treated as an ancillary supply of the original supply, like a composite supply, right? So you will include it in the value. So if you're paying 1 lakh rupees extra on a Benz car to get extended warranty at the time of purchase itself, will it be added to the value of the car itself and then you pay GST. However, at the time of original supply itself, you're not taking Benz extended warranty, you're taking extended warranty as a service from Edelweiss Insurance. Will be treated as a separate supply of extended warranty service. Will not be added to the value of supply of Mercedes-Benz. What if it is taken later? Sometimes what happens, 3-year normal warranty is there. Before this 3 years is now expiring, you can go and then purchase an extended warranty. At that time, whether it is provided by original supplier or third party, I cannot add it to the value of the earlier supply. It will be treated as a separate supplier service. You guys understanding this? Okay, brilliant. So we primarily have looked into how this warranty and extended warranty works. Now what we're going to do is that I'm going to give you a quick understanding of what are the treatments of replacement of parts or repair services during the warranty period. It's a marathon circular. There's so many details that they have given here. I'll try to make it as simple as possible, as short as possible, so you understand this. You know that, say, let's assume the same case of Philips trimmer. Now, you bought a Philips trimmer, you paid warranty charges also at the time, 100 rupees, 1100 is what you paid, and you got this Philips trimmer now. You wanted to get the service done, and Philips is not going to charge you anything, or they charge you 99 as warranty claiming charges or something, and they get the product replaced for you. Question is this: when the original manufacturer provides you repair or replacement during the warranty period free of cost, will that new trimmer that you've got be treated as a supply of goods again? They said no. Why? The amount is already loaded into the original product at the time of purchase, so you've already paid GST to the government at the time of original supplies. So when it is free of cost replacement of item during warranty period, it's not treated as a supply. First understanding. But sometimes they're charging you 99 rupees for claiming this processing of this warranty. There is a 99 rupees nominal charge. Will GST payable on this 99? Yes, that's a separate service of claiming warranty, right? Look at, I have written a note why that concept has come. The cost of replacement would have been already included in the value during the original supply and GST would have been paid. No need to reverse ITC on the parts used for warranty replacement again, because it's something that you already paid GST loaded in the original supply. Sometimes what happens, we do not go to Philips to get the replacement done. To give an example, you purchased a laptop or a trimmer or a mobile phone from Sangeeta Mobiles or Chennai Mobiles, or you purchased it from Chroma showroom or purchased from MyG Mobiles, and it is during the warranty it came up with some kind of a repair. Ideal thing you might do is you will go to this distributor or retailer and then ask them to help you with the claim of warranty. So what happens here? This time the replacement of parts or repair service is not provided by the original manufacturer. It's provided by whom? It is provided by the retailer or distributor. So when it is done like that, okay, by retailer or distributor, etc., will that be considered to be a supply? So said, even if it is done by the distributor on behalf of manufacturer, if it is given free of cost, it is now GST is payable because value has been already loaded in the original product. If there is a nominal 99 rupees charges, GST is payable on that. Now the circular also clarifies how the transaction would work on the back end. This time the original, when the original supply was made, that 100 rupees was collected by the manufacturer. However, this time the replacement happened to be done from whose end? It is done from the end of the distributor or retailer. Now, will the retailer do it free of cost for the warranty offered by the original manufacturer? No. Sometimes retailer will bill the manufacturer and get this amount, or will ask the manufacturer to send a new product for free. So there could be multiple methods in which this can be compensated, and the circular basically clarifies about these transactions. Look at it. Distributor used his own stock or procures from third party for replacement of parts. The Chennai Mobiles or MyG Mobiles, they had a team who's sitting there. They bought from somebody, a third party, say battery needs to be replaced. They bought from somewhere the battery and then replaced it. Then what happens? The distributor, the MyG Mobiles or Chennai Mobiles, this guy gave a bill to Philips saying that this much of amount I incurred for replacing the parts, pay me that. That bill will be containing GST. So the distributor issues tax invoice to manufacturer for the same. GST is payable. Manufacturer can avail ITC on the GST paid. Second model, manufacturer provides parts to the distributor without consideration upon requisition. Now some customer came for replacement. The distributor requested the manufacturer, give me the product. There's been product sent to them free of cost. There is no GST payable because there's no consideration paid on that. Should the original manufacturer reverse input tax credit on the purchase of this product? No, because they've already paid GST on the same when the original supply was made. So Philips is sending parts to MyG Mobiles or Chennai Mobiles or the Chroma showroom to replace during the warranty period. Should Philips reverse the input tax credit on these items and free of cost? No need, is the clarification. Third model, distributor used an item already in his stock for replacement of parts to the customers. Assume when the customer came and then claimed warranty, they took one product and then gave it to them free of cost. Now what happens? This product would have been already purchased from Philips. Now Philips is saying that no worry, I will reverse it from your bill. So the product that was given by the Chroma showroom to the customer, this product was actually sold by Philips to Chroma showroom first. Now Philips is going to reverse that from the bill. How? They will issue a credit note and reduce the liability, right? Manufacturer will issue a credit note, manufacturer's GST liability will go down. What distributor will have to do? Distributor will have to, if distributor has already taken input tax credit on that one item which was given for free, they'll have to reverse the credit. That's all that happens, right? Should the original manufacturer reverse the credit on the item? No, right? Fourth method, okay, same thing. Distributor gave one mobile phone. This time, instead of issuing a credit note, ask the Philips to send one item for free. Like the first one, the second one, it is like They'll ask for the item first and then give that. This time they're giving an item that they already have in the stock and ask them to send the item. Again, the Philips will send one trimmer extra to the Chroma showroom free of cost, no GST is payable, and there is no need to reverse ITC from the end of the original manufacturer. This is the fourth model that we have. So there are four models that we have in this particular case, is something that you have to carefully remember. Is that clear, all of you? Then, apart from replacing the part, sometimes what happens? The distributor will also provide repair services, and service will be given to the manufacturer. Will that be subject to GST? Yes. Manufacturer, if they're giving the bill, it's like the first one. Part they're giving the bill. This time they're giving the bill for services plus GST will be there, and manufacturer will take the input tax credit on the same. So this is a long circular that you have. I know you have to carefully read and understand this model. If you have any doubts, you can ask it on the Telegram group. Okay. So this is what I wanted to recap from value of supply chapter. So I will mark that area as done. I hope this is clear to all of you. So we have done special valuation, pure agent and circulars. All right. Okay. Now we have to start a fresh chapter.